Morning, good morning, good morning. I'm David McGar. This is Property Value, where I talk about commercial real estate focused on South Florida. Today is April 28th, and we're going to talk about mortgage rates because it's everywhere in the headlines. So it goes a little something like this by CoStar Economy. Higher mortgage rates begin to cool the pricey housing market. Uh-oh. And I still need a loan. So, this is by Christine Cooper and Rafael Deonda, CoStar Analytics. With the 30-year fixed mortgage rates dropping 5% recently, home buyers appear to be reevaluating their budgets and pulling back on offers. The reservations come as home prices continue to climb to new record levels. The median price of existing single-family home, for example, grew to $382,000 in March, up 15.2% over the year, according to National Association of Realtors. Meanwhile, the U.S. Census Bureau reported that the median price of new single-family home reached $436,700 in March. That was up 21% year over year, according to the S&P Case-Shiller Home Price Index, which accounts for the same property transactions that closed from December 2021 to February 2022. It grew by 19.8% over the year. While a shortage of supply has propelled home prices, inventory ticked up last month. At the end of March, roughly 830,000 single-family housing units were on the market, according to the National Association of Realtors, up from 740,000 the prior month. That marked a series low going back to 1982. For sale inventory rises in March, meaning less buyers. Rising inventories at a time of declining sales. Counts suggest that more prospective home buyers are losing interest. NAR reported that existing single-family home sales fell by 2.7% in March, while the Census Bureau reported that the new single-family home sales unexpected tumbled by 8.6%. The lack of home affordability is the primary deterrent for many households. Nominal incomes have been rising at their fastest pace in decades, but inflation is cutting into the gains by making many goods and services more expensive. The NAR's Housing Affordability Index, which measures the ability for a typical family to qualify for a mortgage of a typical home, fell in February, the latest available reading, to its lowest level since August of 2008. The index uses the average mortgage rate paid for sales that month, which NAR reported at was 3.83 in February. Rising mortgage rates are eroding affordability. However, many of those mortgage rates were locked in late January. Prospective home buyers now seeing mortgage rates that are significantly higher. The Mortgage Bankers Association reported that the average mortgage rate reached 5.2% during the week ending April 15th, compared to 4.06% during the same week in February and 3.64% during the same week in January. 5.2% in April, 4.6% in February, 3.64% in January. Jesus, someone put on the brakes. It comes as no surprise then to see a pullback in home buying activity. Mortgage applications for purchase during the week ending April 15th. The latest reading fell by 3% from the previous week and were 14% lower than the same week 2021, according to the Mortgage Bankers Association. More supply is on the way for now. A robust construction pipeline should provide a boost to inventories, but builders continue to face challenges in completing construction. The Census Bureau reports that single-family housing starts during the first quarter of 2022 grew by 3.9% over the same period in 2021. As housing starts tend to lead completions by about 6 months in the single-family sector, completions could presumably grow to a pace that's about 200,000 units higher by the third quarter of the year. It seems just a couple months ago we had no supply, and now we are going to have more supply. Multifamily housing starts are on an even faster trajectory relative to their recent completions. In the first quarter of 2022, starts in developments with 5 or more units grew by 26% over the same period in 2021. These buildings take longer to complete, so the lead time in multifamily housing starts to completions is about 11 months, meaning completions in this sector are on track to grow by a pace that will add 125,000 units to the market by early next year. However, the pace of construction could waver as the year progresses. Some home builders have expressed concern that rising material costs will be more difficult to pass on to home buyers now that the mortgage rates are spiking higher. The Home Builder Confidence Index, measured by the National Association of Home Builders, fell to 77 in April, a 7-year low from 79 in March and 83 in April 2021. Most notably, traffic of potential buyers dropped sharply over the past month as mortgage rates spiked. The index is still higher than 50, which signals continued home builder optimism, but builders might be wary of cooling demand in the environment of a higher home prices, deteriorating affordability, push off the plans for new developments until the market stabilizes. What we're watching. On Thursday, the Commerce Department plans to release its advanced estimate of economic growth in the first quarter. Expectations for this number to be significant drop off from the fourth quarter final reading of 6.9, which had been boosted by strong inventory growth. The first quarter of 2022 will likely come in far slower as the economy faces continued supply chain issues, inventory drawdowns, and the impact of Russia's invasion of Ukraine. An undated inflation reading is set to arrive on Friday with the Personal Consumption Exponential Price Index for March, which is expected to tick higher. Again, that was by CoStar Economy, produced bi-weekly by Christine Cooper, Managing Director and Chief U.S. Economist, and Rafael de Anda, Associate Director of CoStar Market Analytics in Los Angeles. Oh my, I got to get my townhouse, got to get my mortgage on my townhouse before these rates go up to 15%. Well, I don't know if they're going to go up that high, but they're definitely on the increase, and they're increasing fast. So, what else do we got? Since the rates are going up, this is from the Real Deal South Florida Real Estate News. Title says, Miami overtakes Boston as the third priciest city for renters. We went from owners to renters. So no one can get a break here. Miami, Jesus, no, it's the best place to live. Rents nationwide notched another new record in April. This is by Susanna Kavanagh. She explains, as I dabble through this, U.S. rents hit another new high in April. Miami edged out Boston as the third most expensive city to lease an apartment. Nationally, the median rent for a one-bedroom hit $1,400, the 13th all-time high in the past 14 months, according to apartment listings site Zumper's monthly ratings. In Miami, rental prices have been rising at a fierce clip. Only in March, the city jumped San Jose to take fourth place among the priciest rental cities. Then rents surged 5.2% month over month to hit $2,600 in April. That pop comes just 2 months after Realty Hop dubbed the city the most expensive housing market in the country. When housing prices rise, rents follow suit as prospective buyers are forced to remain renters, driving heightened demand that pressures apartment supply. In March, Realtor.com named Miami metro area the most rent burdened in the country, as tenants on average spent nearly 60% of their monthly income on housing. Let me rephrase that. It's 60%. The rule of thumb is usually you spend 30% on your housing income, meaning your mortgage payment, your annual mortgage payment, or your annual rent payment. This Realtor.com named Miami metro area the most rent burden in the country, as tenants on average spent nearly 60%. That's double of the national average. The federal government considers any tenant forking over more than 30% of earnings to be rent burden. This is what I just explained. In line with that report, Zumper found that Miami suburbs saw rents rise at nearly the same clip as the city proper, which boasted 38.4% jump compared to April 2021. In Tampa and Orlando, median rents were up 37% year over year. Jacksonville saw prices rise nearly 35% in the same period. Fort Lauderdale rents are 23% higher than the time last year. For tenants hoping that something's got to give with the rental market, report author Jeff Andrews advises, don't hold your breath. Zumper data showed the speed of the rent growth in 2020 2022 so far has trunched the pace of rises during the same period in 2021. The national median rent for a one bedroom has risen 3.2% so far in 2022, nearly twice the 1.7% increase seen over the same period last year. Andrew said the market correction theory that rents would eventually catch up to the rising home prices and normalize doesn't appear to hold water anymore, but he did see potential for a pressure valve opening in the coming months. As more leases expire this summer, Andrew said, all-time low vacancy rates could tick up, giving renters more options in a hot market. Whether that actually results in rent growth slowing down remains to be seen, Andrew says. Great article, and we'll keep our eye on that. This is what we do. We do market analysis on rents and prices and values, and this is a big deal. This is cost of living here in Miami is going through the roof. I mean, what do you expect though when they put rent moratoriums on, on multifamily properties and landlords weren't allowed to evict anybody, and now everything opens up with COVID pretty much gone. Still cases out there, people getting sick, but the mask mandate is over and people are coming and going as they please, and restaurants are up and running, even though they're still looking for money. But landlords weren't allowed to really evict or raise rents, and now they have the opportunity. They had the opportunity in the last 6, 8, 12 months, and they're taking advantage of it. Do you blame them? Okay, so, and with that being said, and with people and the population growth in South Florida, and people migrating to these warm states that have no state income tax, and new possibilities for jobs and ability to go to work and not wear the mask and live life as it used to be. What else prospers? Well, we saw Amazon take off and build a bunch of distribution centers all over Florida. And well, we also have our supermarket, and our supermarket is Publix in Florida. So what's happening with Publix? Talking about retail. This is an article by Brian Bandel out of the South Florida Business Journal. Publix supermarkets filed plans to more than double the size of its distribution center in Boynton Beach. Double the size. The city's Planning and Development Board will consider on April 26th the site plan modification for the 63-acre property near the Gateway Boulevard. It currently has 443,000 square foot, but Publix warehouse built in 1989. But Publix wants to go bigger. Publix wants to expand the warehouse with 571,000 square feet of additions. That's double what they have. That would consist of 551 square foot warehouse for dry goods and another 19,000 square foot for returned items. The new warehouse would rise 48 feet. That's a big clear height, 48 feet. Usually warehouses are around 28 to 34. They're going up 48 feet, which is significantly taller than existing warehouses. What does this mean? That means that online and delivery for goods is crazy right now. Publix reported a 7% increase in sales to $48 billion for the fiscal year ended December 25, 2021. As its sales increase and it both builds new stores and expands its existing stores in South Florida, the company needs more warehouse space to handle this distribution. Good for Publix. One didn't say where they're building it. They're wondering if they're building blah blah blah. Oh, Boynton Beach, Palm Beach County. Not in Miami-Dade, not in Broward, but in Palm Beach County is where they're expanding. Okay, since that is retail, I kind of wanted to dabble in and look at what is going on in the retail numbers in South Florida. Publix had me curious. So it says that today on April 28th, that there's 328 million square foot of retail space. That's up only 0.6% year over year. Under construction is 4.2 million. That's 12% of the existing inventory. We have a vacancy rate around 3.7%. Market rent per square foot, $35. Triple net. That means that the pass through, all the expenses are passed through, and $35 is the true absolute base rent. That's up 8.5% year over year. So $35 up 8.5%. Market sale price per square foot, $347. That's up 7%. So far, everything's positive in every category that I've just gone over for retail. In the market cap rate, 5.8%, holding steady year over year. So the retail looks strong in South Florida. We don't see any hiccups, maybe with inflation going up in the cost of goods, but with Publix trying to expand, I don't see any indications. Let's just fly through these charts real fast and see if anything jumps out to us. Everything looks like there's vacancy rates going down. Other thing, rental rates were all going up for the next 4 years. It shows rates increasing, trajectory is positive, net absorption is positive, leasing activity is positive, and sale price per square foot, sales by transaction, cap rate, compression. After cap rates have been compressing since 2020 Q4. And it's cap rate by location type, market cap rate looks like it's going to stick around that 5 point, right around just slightly lower than 6.6%. This is against all classes as well. So you have your everything thrown in there, from strip centers to community centers to single tenant and freestanding, everything retail. Market cap rate by location. Nothing's jumping out. No red flags to look at. For total sales, top buyers in the market were Kimco Realty Corporation, but here we go. Top sellers were also Kimco Realty Corporation. Brokers, asset value by owner type. Looks like the 61% is private equity buying these assets. Not much institutional, only 9%, REIT 9%, private equity is 3%, 61% is private money, excuse me. Sales by seller, sales by that, asset by owner origin. Oh, here's a pretty cool chart, which it shows on the left right here, that 45% of the South Florida retail is being bought locally by local buyers. There's 4% of foreign ownership coming in, and 51% of national ownership from national companies, institutional companies buying. Average cap rate by buyer origin seems that if you're a foreign buyer, you're paying a lower cap rate, which means you're paying more for that asset. National buyers are in the middle between the foreign buyers and local. And it looks like local people are getting a little bit better deal with a little higher cap rate. Maybe they're more risky, or they know the area a little better because they live here and they have boots on the ground. Anyways, that's my look at retail. Wanted to really jump over here again. We've been watching the 10-year Treasury note. This is by Wall Street Journal Markets at back to 2.874. Yesterday it was at the 2.7, so it did slightly increase. And the mortgage rates for today, Thursday, April 28, 2022, the average rate for the 30-year fixed is 5.42, up 15 basis points from a week ago. If you're looking to refinance your current loan, the average 30-year fixed refinance rate is 5.42, an increase of 17 basis points over the last week. Meanwhile, the average 15 refinance rate is 4.65, an increase of 21 basis points over the last 7 days. And that's it, guys. Thanks for listening. I'm David McGarr, Property Value. See you next week. Have a great weekend. Bye.